Value stocks have recently been outperforming growth stocks. But will that trend continue? This is The Chart Show. On The Chart Show this week, we're looking at the ratio of value stocks versus growth stocks and the key relationship that ratio has with US Treasury yields. Value has recently been outperforming growth, and tactically, it looks like there's more room for this ratio to run in favour of those value names. But what are value and growth? Well, very loosely, value stocks tend to be relatively cyclical sectors that outperform during periods of economic expansion, and vice versa. And such sectors could include resource names or banks. Growth stocks, well, they tend to outperform when the economy is sluggish. The growth in growth stocks actually refers to the ability to grow earnings on a regular basis, regardless of the underlying economic conditions. Many of the large cap technology names fall into this growth category and have performed well since the pandemic struck last year. And for this analysis, we're using the MSCI All Country World Indices for value and growth. So why do these sectors have a relationship with yields? Well, the level and direction of yields reflects the strength of the underlying economy. Yields should be lower during periods of economic weakness and higher when economies are rebounding. We use the US government 10-year, called US Treasuries, because they're often used as the global benchmark. And if yields reflect the underlying strength of the economy, then value and growth should ebb and flow with those moves in yields. So let's look at what's happening today and why we think there's more potential for outperformance of value over growth. And within the value space, we'll also look at which sectors are our preferred plays. But first, we'll kick off with the S&P 500. So here we are, 2/3 of the way through 2021, and the benchmark US index has just experienced a 5% drawdown into the end of the third quarter. Now, during this same period, US Treasury yields have been edging higher in response to a hawkish tilt from the US Federal Reserve and increased inflation concerns on the back of tightness in global energy markets. This, in turn, has been raising concerns that inflation could eventually run into stagflation. And all of this is taking place to a backdrop of a deadlock in US fiscal policy and ongoing geopolitical tensions. Now, these higher yields should be favourable to outperformance from value sectors, and most of the recent outperformance in value versus growth has taken place since the September 22nd US Federal Reserve Open Market Committee meeting. Since then, Treasury yields have gained over 20 basis points to break the 1.5% level. And this phenomenon of higher yields is not just confined to the US. In Europe, both Germany and the UK have also experienced higher yields, with the UK's benchmark 10-year gilt gaining about 30 basis points since the end of August. With high yields generally indicative of a better environment for value rather than growth stocks, we are seeing a rotation into value areas of the market, leading to this relative outperformance versus growth. And during this period since the 22nd of September, the MSCI Value Index is down 0.5%, whereas the MSCI Growth Index has fallen much more, by 4.6%. This relative performance is consistent with the trend that we saw during the February to March 2021 period of rising yields, when value outperformed growth by nearly 9%. But which are our preferred sectors? Well, within the value space, we like energy and financials. The Global Energy Equity Index has outperformed the broader MSCI index by about 24 percentage points year to date, during which time Brent oil prices have risen to above $80 a barrel, the highest level since 2018. We still think that energy equities look cheap relative to oil prices, given our view that Brent will remain above $75 per barrel right into year end. That price should be supportive of energy equities. There is even the possibility that Brent oil prices could move higher if there is a cold winter in the Northern Hemisphere or the current energy disruptions persist. And furthermore, OPEC Plus are showing no signs of increasing output from current levels. And the other sector we like, financials, also benefits from economic growth and higher yields. By way of example, US banks tend to outperform the broad market such as the S&P 500 when US Treasury yields are rising and vice versa. And it's quite a close relationship. A pickup in economic activity helps fuel lending, whilst rising long-dated yields can help a bank's interest margins. But there's also one other thing that's worth highlighting, and that's whilst we remain risk on, October has historically been a volatile month. there are lingering COVID concerns. There's China's rebalancing to contend with, and the ongoing issues around an energy shortage that could make the next few weeks a bumpy ride for investors. That means investors may want to diversify their risks over this period, and it's one reason why we like market-neutral value versus growth plays that should benefit from our view of higher US Treasury yields.